We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Wojcicki. Joining me today is Andrew Gilbert, founder of Sniper Trading, Discord trading community. How are you today, Andrew?
Hey, Tom, I'm doing great. Glad to be back on.
Excellent to have you back. So I think we should start today by having a discussion about how important the Fed is at this point and how that is really driving how you see the markets developing from here.
Yeah, well, I mean, the Fed is critically important in how your asset class is going to perform. And anytime we've got a tightening cycle, you're going to see the S&P, Bitcoin, NASDAQ, the whole of assets decline as there's a disinflationary event. And so it has a major impact on the stock market, and especially at this critical point with us having such a massive parabolic rally and all that additional stimulus and growth that occurred. We're now tightening into a slowdown and a slowdown in growth. So when those two things occur, you're just going to have a sort of a capitulation event in the S&P, which is going to drag everything down. And, you know, the Fed affects the volatility of assets, and then the volatility of the VIX affects the S&P, and then the S&P affects the NASDAQ, the Russell, Bitcoin, and basically every other asset class. Mm-hmm. So the Fed is the market maker at the end of the day. But people talk about it in trading fields. The market maker runs the show, but ultimately the Fed is the godfather of market makers. And when they turn liquidity off, you don't want to be long anything. You want to look for shorts. You want to look for bounces like this in March, or bounces that we're getting right now in early June or late May, to get back in on the short side for the next leg lower. And so I think it's really important for people, the average person, that if you're listening to somebody that is giving sort of a contrarian opinion, I don't know, or a hyperbolic opinion on something that is less likely, you need to look at their opinion and look at what the Fed is doing and say, if the Fed is tightening and this guy is talking about a melt up, I need to trust that because the Fed is tightening, that his opinion is likely incorrect. And that's the same with anyone who's going against the Fed is likely to lose a lot of money. So don't go against
trying to really understand the particular timing of that call, right?
Yeah, exactly. So the Fed runs the show, and so don't fight the Fed is what everyone talks about when the bull market's going up. But on the way back down, everyone's like, "Oh no, it'll be fine. Don't worry, the Fed will step in." The Fed hasn't stepped in. We're 20% down on the S&P, and they haven't flinched. We'll have a 50 basis point hike in June. Mm-hmm. Asset roll-off has started today, and we have another 50 basis points in July, and things are going to get real hairy real fast. So, my opinion, and obviously not financial advice because I can't give it, but you know, only lower is where we're going until the Fed takes a pivot from taking liquidity from the market to adding liquidity to the market.
Mm-hmm. And of course, we're speaking here on June 1st. And it seems like we've had a little bounce here, but how do you see that bounce developing in the S&P? Is that somewhat of a dead cat bounce, or just a relief rally within this, as you're kind of telling us, this larger bear trend until we see maybe the Fed step back in?
Yeah. So that's exactly what this is. This is a short covering rally by the hedge funds. This isn't retail. This isn't retail buying. This is institutions who are covering their short positions. So when you're entering a short position, you sell, the market maker buys, and when you want to take profit, you've got to buy back that stock. after you've sold at a particular price, and then the market maker has to take the sell side on that particular transaction. So this is all institutions taking profits from their short positions that they've been taking along this downtrend. And so what's likely to happen is it's going to run out of steam. You're going to have here is option one, where we hit this large structure level here in the S&P, which was obviously the March bottom before we had a massive rally. This has acted as a key level of support. Even on this downtrend after that high, it got a bounce along here. You can see at the top end of this market structure box, you've got lots of support here, which would now act as resistance. And it's very unlikely that we see a high higher than 4,300 before we get that next lower low in the S&P. And just to show that it's not just a lot of BS that this market structure box will hold, if we go even back into the 1970s here, just for a quick moment, see here that this market structure area here, we got a breakdown past this key level of support, broke, back tested this level as support, broke back up, hit that market structure box, broke down, then found support here, came back up, didn't even manage to get back into that market structure level before a breakdown. Then you can come over here to the 1970 crash. You can see market structure box here, had support here, support, resistance, support, another area of support, break that level of support, came back down, came back up, only came halfway into that box before a breakdown. So, the market structure is pretty key in determining whether we're breaking into an uptrend, downtrend kind of thing. And I would expect that we definitely don't make it past 4,300 before we get another break to the downside here.
Mm-hmm. And you were saying we're something like 20% down from the top at this point, right?
Yeah. We're 20% down. So just grab from
what do you think the likelihood of the Fed stepping in, let's say when we get to 30%, is that a particular number that you think they're maybe worried about, or is it, disorderly market sell-off? What do you think might be the catalyst for them to step back into the markets?
Well, it depends, because we don't know how adamant Powell is about, moving forward with these interest rate hikes and trying to get to 2-3% by the end of the year, going to neutral and continuing the asset roll-off. It all depends on whether something breaks from a credit standpoint. And of course, back in the 2008 crisis, they were running out of money. So people may have not been able to take money out of the bank accounts and all that kind of. So we need a big crisis, I think, to initiate potentially a Powell pivoting. But of course, I can't read Powell's mind. Mm-hmm. So if we are to sort of guess based on his previous actions, we might see a 30% drop, where sort of news media, government start to get concerned about the stock market, get concerned that demand and growth is slowing and job layoffs are starting to occur. And then Powell may step in at that 30% mark. Of course, we can go lower. It all depends on how Volckerish the Powell movement will be. Mm-hmm. But based on past experience, Powell may pivot at 30%. But he does need to kill demand because of the inflation. So it just really, it's quite dicey to say, 30% and then he'll pivot. Mm-hmm. But that is the next target, because it'll cause news. It'll cause the government to start talking about it. We're down 20%. Nothing's been said. I think the next key psychological level is 30%. And then we'll see what Powell does at that point. But I think 30% is the next key level to be aware of, and that's what we'll be doing in sniper trading. We'll be trading in that direction once we see a topping formation, similar to what I've drawn out here on the S&P.
So you were kind of talking about the how you see the order of operations really. So how do you use the VIX as a tool, or something to inform yourself of other moves in the market?
Yeah, well, the VIX is obviously currently in an uptrend at the moment, and that's all down to the Fed. When the Fed takes the liquidity away and starts to increase interest rates, it causes an uptrend in volatility, and this volatility is correlated with the S&P. And so once you see that volatility increasing, it makes markets unstable, which causes those down moves in the S&P. So as you can see, we're in an uptrend. We're likely to continue this trending volatility on the volatility index until we get a step in from the Fed, because they will suppress that volatility when they start buying treasuries and securities and mortgage-backed securities. So yeah, the VIX helps you understand exactly when a pivot from the S&P is likely to the downside. You'll see it in the TDI here, and then also in the MACD volume here. So the VIX is very helpful in understanding. Once we sort of get past the 30 level, things start to really shit the bed in terms of moving the stock market lower. So it's quite an important thing to be aware of, and it's influenced by the Fed, and then it's a knock-on effect throughout the market.
Mm-hmm. So is it possible that we see, with more volatility, we see more demand come back into the dollar because people are trying to jump out of the stock market, and that drives the value of the dollar back up?
Yeah, 100%. Like, we've been in an uptrend in the dollar since 2008 financial crisis, and it's definitely on the rise until we start to see a capitulation event in the stock market. So if we pull up the S&P here in orange, this orange trend line, you can see in the .com bubble we had a massive capitulation, and that caused that massive drawdown in the dollar because people wanted to reinvest after the capitulation. And so that dollar is going to continue to pump to the upside until we start to see that big drawdown in the S&P. So basically, we're waiting for a big recession to come along before we start to see a reversal in this dollar trend since 2008. You're likely to see a rally in the next couple of weeks in the dollar. So we were bottoming out here on the 4-hour time frame. You can see a lot of bullish divergence here where the price goes lower, but the oscillator continues to move higher. And I was discussing this on the weekend with my Discord members that we would see a pop to the upside in the dollar, and obviously that's exactly what's happening right now. And we're likely to either break. I think it's very likely that we break above current highs and head up higher. The further and closer we get to a market bottom.
So how do you see these tightening conditions and the runoff of the balance sheet affecting gold? We've seen it range bound and hold relatively stable compared to a lot of these other assets. So how do you see the chart developing on gold?
Well, basically, it's going to follow what the S&P is doing. So if the S&P is going to break down further, you're going to see a further breakdown in gold. And last time I was on, we did the Wyckoff schematic explanation of price action, and I was expecting a spring to happen. We were in around this price action the last time we were on, and we got a big rally, and that was down to that Russia invasion of Ukraine. Something I couldn't have predicted, and of course we're still in that range. So you've got to ask yourself, what catalyst greater than a war on Ukraine is going to break you out of this range? And the answer is you've got to wait until the Fed has to pivot back from tightening conditions, and that will release gold into higher levels towards that $3,000 level. And so what we should expect, what I think is the most likely scenario for gold here, is that we don't get this spring if we get a pivot from the Fed at that 30% drawdown on the S&P. Similar to this schematic here, the accumulation schematic 2 for Wyckoff, these are the last points of support, and they backtest the key levels of this particular range. And so you'll see here, we're in this particular range here. And so a backtest of 1680 is the most likely if we get a pivot from the S&P from that 30% drawdown. When the Fed says, oh, enough is enough, we'll start buying and stop retracting liquidity. And so that is the most likely for gold. For silver, it's acting slightly differently because obviously it's an industrial metal. When industry starts to slow, things start to become a bit cheaper because demand dies off. And so we are going to see that spring in silver, which is obviously the accumulation schematic 1 here of the Wyckoff price action. So we are likely to see that spring where we break those key support levels and come lower, which is what we've done already. We've come down towards 20. And so the figures that I talked about in the last podcast of 18 to 17 is likely to get hit before we get a move out from obviously the Fed pivoting from tightening to easing. And so those are the most likely scenarios for gold and silver, just like it's the most likely scenario for the S&P to continue down 30% and for the dollar to increase in value as we near a market bottom for the S&P and the stock market.
The dollar to increase in relative value to the other
yes
currencies that are also being devalued, right?
Yes, everything's like because the dollar doesn't have great competition. It's the strongest of a bad bunch, basically.
Mm-hmm. So the last time we were together, you made a pretty bold call on Bitcoin. So how are you seeing the correlation to basically the S&P and maybe the NASDAQ right now to Bitcoin?
Yeah, well, I mean, the correlation between the S&P and Bitcoin is 0.95%. So it's basically a 1-to-1 correlation. So every time the S&P drops, you're going to see Bitcoin drop. S&P is dropping today. You're getting a retrace here now in Bitcoin as we speak. And it's going to follow the S&P. So if the S&P is going down to 30% drawdown, then you're likely going to see that 20% or that 20K Bitcoin, if not lower, relatively soon. I did say by the end of June we'd see 20K. We're getting pretty close. We got to 25K on the wick. And so it will depend on how quickly things deteriorate over the next month. But 20K is definitely coming for sure. And I wouldn't be surprised if we see 10K, depending on how quickly the Fed pivots and how much of a drawdown we see in the S&P. So, it was a good call to make. We were talking, what was that, January? Yeah, so we were talking back here where a lot of crypto people were still talking about higher highs, 74K, 100K, 250K. And, I came on here and I said it's the most likely scenario is 20K. And I even gave sort of a date range of when we should expect that drawdown towards 20K. And we're getting very close to being 100% accurate.
So, Andrew, do you think that, when we get closer to that 20K level that, this last dramatic drawdown we saw, USDC and Luna obviously kind of spectacularly blow up.
Yes.
Do you think when we get closer to that 20,000 level that we see more of those margin calls come into that market and a lot more of that leverage and liquidity come out and blow up out of Bitcoin? The surrounding ecosystem.
Yeah. You're going to see a lot more zeros in the altcoins for sure. So, Luna dropped from 80 to 0. Don't be surprised if you see a lot of other altcoins going to 0. The further we break down in Bitcoin, I'm out of USDT. Once I saw the UST thing, it was like, right, I'd prefer to be safer than sorry. And so I've moved my money into real currency backed by governments, other than just a random stable coin. And so that's why I've moved my assets, my money into eToro, which is obviously a stock trading platform,
Mhm.
and is backed in US dollars. So that's that's my current setup, and it's just purely for safety reasons. We were obviously out of all our spot positions. We got out at 52K back in early December, which I mentioned in the last podcast. So we've been basically slowly evacuating from cryptocurrency as it's continued to capitulate.
Excellent. Is there anything else, any other charts you'd like to go over before we wrap up, Andrew?
Yeah, just on the bond yields here. If we could just pull this up here. So a lot of talk is on when bond yields move down, that's sort of the end of the Fed tightening, etc. And so I just want to give people a general time frame for when they should expect a move down. And you can see we get these topping formations, which kind of look like M patterns here on the weekly time frame. And that generally signals the end of a move up in yields before we get that capitulation lower. And if we go out in the monthly time frame, you can see we've just been continuously going down. So we are likely at the top in terms of bond yields. But what you should be looking for is an M pattern formation forming over the next 3 to 6 months before we start to see that sort of breakdown in yields. So we do have another 3 or 6 months before we start to see that capitulation, because we've only just hit the top of the range, which is most likely 3%. So you should expect another move to the upside here before we get that breakdown in yields. And that will obviously lead to a potential trade setup here in TLT and a nice long setup for TLT, because it's the opposite. It correlates in the opposite direction into yields. So we'll probably be looking to get in at around 110 to 100, depending on the spike up in yields as it forms that final M leg over the next sort of 3 to 6 months. So yeah, that's basically the only other chart I think is worth talking about. But it's going to be a very interesting next couple of months. And if you want to learn how to trade properly and you want to listen to somebody that's not going to feed you unlikely scenarios and give you the most likely scenario, then you need to have a look at sniper trading.
Excellent. And of course, your Twitter and your Discord channels are a big part of how you communicate with your community, right?
Yeah, 100%. I mean, we're very, very active in the Discord, and obviously I share my opinion on the sniper trading Twitter page at Sniper Trading 1. So if you want to have a quick look on Sniper Trading 1, you'll see our YouTube channel, you'll see the link to our Discord, and there's a free chat there. So if you want to ask any questions, you're free to do so.
Excellent, Andrew. Well, it'll be interesting to see how all of this develops, and thanks for giving us some perspective on how you see the markets developing in the months ahead, and what really matters as the Fed is, in some ways the only game in town that yes. is to be watched, right?
Yeah. You just got to watch the Fed. You can ignore everyone else. That's what I do. I ignore every other YouTuber that's available because the Fed is the most important. The Fed runs this show. And so if it's tightening, you don't want to be long anything. If it's loose, then you want to hop on everything because it'll all just start to go up. Mm-hmm. So yeah, wait for the pivot basically to go long.
Excellent. Thanks for your time today, Andrew.
All right. Thanks, Tom. Thanks for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.